Good afternoon, and we'll get started. I want to welcome the panelists to the floor here and introduce Ajay Marwaha. And he is the, I'm presuming everybody knows you all, they don't know me, but that's true, I know this. But he is the head of global fixed income, and I think maybe some folks are not aware of the fact that he spends a good amount of the year in London as well. So he is bicontinental in the context of bond market availability and visibility. And Vijay is the CEO of INEX, now Gift City, the exciting endeavor and evolution of the global India capital markets representation, and we're very excited to have you both here with us. Manoj needs no introduction.
Tom, instead of that, why don't I introduce you? Because I'm already introduced.
Yeah, okay, okay.
So no, I think it's important to introduce Tom, not just as an advisor with Harmoney, because he, like me, is sold on this story. So he came on actually earlier than me. But more importantly, he was COO of Market Access. A lot of you already know about Market Access, and spent considerable time with fairly large investment banks. Was Morgan Stanley prior to that? Which others, Tom?
Goldman and Jeffries, and I also was CEO of Bonds.com.
That's right.
The original is very, I mean, everything I heard in the first panel was very interesting to me. I asked one question, I had 20, but I also had 20 observations. In 2000, when the SEC mandated that TRACE was going to come into existence, in the year 2000, TRACE, the SEC mandated that TRACE, the tape for bond markets, was going to come into existence. I was the chair of the Bond Market Association that had to tell the rest of the street that wanted nothing in the street. By that, I mean the two-way dealer market, Goldman, Morgan Stanley, JP Morgan, that wanted nothing to do with TRACE and nothing to do with electronic trading. And I was at the forefront of saying, neither do I, but I have got the, Arthur Levitt is the chair of the SEC, and he says it's coming, and it's a train, and it's going to take us out if we don't cooperate. So that was the end result of the 2000-2002 TRACE evolution. In 2018, I joined the SEC again in their first inaugural market structure committee as a member of that committee. Of all the people that thought about, given the fact that we'd had 18 years of evolution, we still need more. And that committee still exists today. So evolution in the bond markets is a never-ending process. You are in the equity market in an advanced, exceptionally advanced stage of that evolutionary process. In the bond market, I took away from the first panel growth. You're going to have a growing economy, which you have. You're going to have 6 times GDP in 22 years. And you're going to have an enormous growth opportunity in the bond markets as well. And that evolution of maturity is going to open up numerous opportunities. Something is going to give, and what it looks like and how it will work, obviously this is what Harmoney is working on. So with that in mind, I think we can maybe give a little bit more color. We have some probably overlap with what you heard already because we're talking about the bond market. It's not a different topic. But I welcome the conversation, and thank you everyone for being here. So over the last 10 years, as was discussed, volumes have tripled, but over the last 5 years, they've been stagnant in the secondary market. Ajay, you were part of the Gandhi Committee in 2012 that had numerous recommendations for improving liquidity and market evolution. And I think the conclusion from the first panel was that we really haven't made a lot of that progress. But what are your observations? What do you see has been progress? Because things have changed. There's an RFQ system. There are things that have changed. But there's also things that still need to progress. What is your observation?
Oh, thank you, Tom. And thank you, Harmoney, for having an event like this. I mean, I'll take a step back. The first such event that I attended, I was very young, probably younger than the Harmoney team. I was 27.
The entire Harmoney team except Manoj and I.
I was 27 when I attended my first panel on increasing liquidity in the corporate bond markets. And I was privileged to have members from the Reserve Bank and SEBI on that panel. And we were all, 27, enthused. All that's happened over the last 27 years is that I've doubled in age. Not much has changed, unfortunately, in the corporate bond market. Tom mentioned change. And I think the last panel had a couple of very interesting observations. And I think it's important to kind of link the two conversations, and I'll start with that. I think Amit very importantly brought up valuation. And then he also brought up motivation. And to be honest, the nature of the beast is a combination of these two. Unless you have motivation driven to basically bring what we know as an arbitrage-free pricing model into existence, there won't be a market. And frankly, that's one of the reasons we don't have a market. Well, we do have a market, but we don't have really a secondary market worth talking about in corporate bonds. I think multiple times we spoke about, and Tom, you yourself asked as to why there is differential pricing in two assets, which are same category from a credit perspective, similar sort of duration. So both the credit and the interest rate metrics are exactly the same, but the numbers don't work. If you have a market that drives homogeneity in those numbers, that market will work. And that market really is a market which brings those two players in line if they are forced out of line by regulation. This is exactly the discussion the Gandhi Committee had when we were talking about the government bond market, funnily. And then we had NDS home, we had trading, but the volumes had really not picked up to the extent we expected it to when it went electronic, when we had guaranteed settlement. So we had a lot of the inverted commas process sort of upgrades that had taken place. And one of the first things that panel discussed, and we were all privileged because that was the first time the Reserve Bank of India had opened its doors to private banks to come into a discussion on market development. It was unheard of. And it was all driven by Dr. Khan at that time, Dr. Gandhi at the time, and of course then later on furthered by Dr. Rajan when he came in. Shorting of government bonds then became the mantra.
And it exists now.
Yeah, of course it does, yes. And that shorting of government bonds led to a massive increase in interest from market participants. Of course, different degrees of shorting are permitted depending on the liquidity in those bonds and the outstanding number of those bonds, etc. And that helps the yield curve to stay more or less balanced, because the moment there's a kink and there is an ability to short the kink, you will get that curve to come back online. In the corporate bond market, we're actually 4 or 5 steps away. We're talking about liquidity creation and repo at the moment, right? So I think, to be honest...
And you can't short, which was my first trip to Mumbai was February of 2024. And when the Harmoney team told me that you couldn't short corporate bonds in India, I took a step back. I said, how could a market function? And, I've obviously learned a lot about why we are where we are, but that was an amazing revelation to me as to an explanation as to perhaps partially, not fully, but partially why.
So
we haven't
for people
made that
like
progress.
Manoj and myself, it's been a slightly less amazing revelation because we've lived through that revelation, and the day and the book of Revelation still isn't here. So, we still are where we are. I think the point is that, when we're trying to compare the domestic bond markets with the international bond markets, a lot of people forget India's journey into markets in general. India was a protected economy, needed to be a protected economy. Today, we probably have, when you see young people, when they study and come out to the new India, which is the 6th largest or 5th largest GDP, there is a certain euphoria about ourselves. We forget what we've come through. And therefore, you kind of take it for granted, okay, if the UK can short gilts, if we can short, corporates, why can't I do it here? Well, you can't do it here because of that stage of evolution that we've gone through. So there is a massive catch-up that needs to take place. I'll cut this short. I think we need to be calibrated in our approach. And I think this rush to compare ourselves with the United States, with the UK, with Japan, I think we need to curb that a little bit. Let's take the baby steps.
1, 2, 3.
Yeah, and we'll get there. We're headed in the right direction. I have some numbers which I'll share once the other panelists have spoken. So the building blocks are here. The intent is here. There are some massive gaps. I think Amit was very kind and polite. He knows I'm slightly less polite than him when I discuss markets. I don't think there are cracks. There are huge gaps which we need to plug before we will get a more efficient corporate bond market in place.
So, Vijay, one of the things I want to make sure everyone is fully aware of, but they probably are, is the fact that you were at the BSE before INX. So you have this other perspective. You also were a key element in developing the RFQ system within NSE. So I would love your perspective on our fixed income markets today.
Surely. Thank you so much, Harmoney team. Thanks, Tom.
Yeah.
That's okay. So thank you so much for having me here. It's been a little over 20 years that I've been part of the Indian domestic fixed income market. Of course, still learning. It's always an evolution, so still learning. When I look at it from my perspective, of course, they are veterans who've seen markets much earlier than me. From my perspective, yes, of course, when we talk about liquidity and development of secondary market and so on and so forth, yes, we have some way to go. But having said that, in a corporate bond market in India or in the debt market in India, we have come a long way, right? When I entered the market somewhere in 2002, okay, we were still on a telephone market on the GSEC side. There was not much transparency. The numbers were not available. We didn't know what the yields were, what are getting traded, whereas the issuance, the primary market issuance of CPs at what level issued, there was absolutely nothing which was known, and there was absolutely opaqueness, there was no price transparency, nothing, right? Cut that and come now, right? The market is fully transparent. The reason I'm saying that is, right from the primary issuance market, you have the, everything needs to be done, anything which is an issuance above 50 crores needs to be there through the electronic book building platform, which is EBP of the exchanges. And immediately after that, end of the day, the cutoff yield and...
I might add, that's actually an advanced effort relative to the global markets and how they developed. Yeah. So in that sense, India is ahead of the markets in that regard and where it is on the new issue side.
So the primary markets, started becoming quite transparent in that way. People started knowing where the securities are getting priced, at what level, so on and so forth. So that started happening with bonds, right? So that was the very first step of things, and data started getting disseminated. Secondly, what happened is, right from the GSEC days, I'm sure the auctions were more written on the paper and then submitted to the RBI. We moved electronic, right? So now you go to the RBI's website, you know who has bid what is the weighted average, and the data is available there for everybody to see. Right, and similarly thing happened in the corporate bond market, wherein it became more that all trades need to get reported, so on and so forth, right? And today it is far more. So I'm not saying that 100% of the trades still get reported, but a majority, more than 90-95% of the trades are getting reported, and people are knowing where the price is and where the pricing is happening, right? Before COVID, okay, when we talk about the volumes on the equity side of the market, right, and post-COVID or during COVID and post-COVID, when we see about the equity side of the market, there has been a stark difference in terms of the kind of volume that has picked up, right? What is the reason for that? Electronification, right? I am sitting at home during COVID, I have a mobile, I have an app of a particular broker with me, and I just keep trading. I'm doing nothing, I just keep trading, right? So that introduced a lot of retail into the market, a lot of retail into the cash market, a lot of retail into the derivatives market, right? So are we there with respect to the equity market? The answer to that is no. But as rightly Amit said, the heart is in the right place. We are taking steps, right? But we need to move a little bit more faster, is what my sense is. We are there, we are taking the right steps, we're making the right noise in terms of the payment systems, in terms of the settlement cycle, in terms of the seamlessness in which the settlement is happening today in the corporate bond markets. We are there. We are very much there. See, even for me, if I was to look at a corporate bond per se or a debt per se, it is an hold to maturity instrument, right? So somebody who's coming into the market and, I'm going to buy that bond, or it's a privately placed instrument, I'm going to buy that bond. I'm taking that bond based on what is my terms and conditions, and I'm asking the issuer to place that bond to me based on those terms and conditions, which means I have all intents to hold that security with me till maturity. And there is no intent for me to come to the market to do a transaction. Correct? Now in India, who's the one who's actually the trader here? The trader are mutual funds. If you look at statistics, if maybe a little dated, but having looked at it, if you compare the trades on either side of a transaction, 50% of the time there is a mutual fund. Because of the nature of their business, because there's a money coming in and money going out every single day. Like Amit mentioned, he has to manage liquidity every day. So there's a need for him to do that transaction. Now by virtue of some of the other institutional players like a pension or an insurance or a bank, right, they are typically long-term players, and their regulation and the regulators also mandate them to be in certain asset class and certain credit class and certain credit. So when we say India as a market has not developed below the credit curve, is because I am not allowed to invest in below a credit curve. Then why will I take that credit risk? I will not take that credit risk. A mutual fund was taking that credit risk to some point of time, but certain events happened, and then the credit fund started deteriorating. And that is what Amit said, right? The appetite exists today, but they stopped providing the opportunity for somebody to take credit, right? So my take is a little different from the first panel, and some of these things we have come a long way. Regulatorily also we have come a long way in getting the exposure, in getting the transparency right, in making the market feel, okay, this is the price for a security and this is where we are. And RFQ has also led to a fact, although it is still not achieved its objective, or it's not even 0.1% of its objective is achieved in terms of what an RFQ is. But what I frankly feel it has done is it has got the electronification going there in the bond market, and OBPPs, the online bond platform providers, have really helped the cause in getting the retail guys into the picture.
Yeah.
The volume of transactions is not too high. So like an institution, if I'm doing a transaction worth 25 crores or 50 crores of a transaction, a retail guy will not do that. But what has happened is the number of trades that you would see in a corporate bond has significantly gone up. The value is small. The value is very small. It could be in some thousands, or it could be in a few lakhs. But what has happened is we have seen the number of participation increasing. And that's because people have the ability now sitting here to understand, oh, this is that is a bond available that is giving me a 10% yield or a X% yield. I have money with me. I have 10,000 rupees with me. I don't want to park it in a bank that's going to give me 5%. I will park it in a corporate bond that is giving me an yield of 8%. So that is what it has led to. That evolution has happened. It has started to happen. And honestly speaking, I am very hopeful that this, in the next few years to come, of course, there is a lot of other issues which is there, like Amit spoke about, right? Which is homogenization of the corporate bond market. Today, if I was to take an issuer as a PFC as an issuer, which is one of the most common issuers, within a particular year of maturity, he would have at least 25 bonds outstanding. Yeah. So if I was to buy a PFC bond as a retail investor or somebody, I do not know what it is. I don't know which bond I want to buy. Or I have some bond in mind, but that's not the bond that I want to buy. Because as an ISIN, I will never remember. In equity, if it's a Reliance, it's a Reliance. Come what may. Right? But in a bond market, if I'm saying a 10-year PFC bond with a particular month maturity, there are at least 3 or 4 bonds in that. And so electronically doing that, right, for a retail investor is very difficult, because he don't know which PFC I need to select. And that is where, when Amit said, an equity works with a member or an intermediary, why can't a bond market work like that? So if I have an intermediary, I tell him that this is my requirement. He identifies what it is. That is what is beautifully being now done by a lot of these players today, wherein they are able to give the retail guy or even the institutions guy struggle. Without a broker, when we say the RFQ platform today is not achieved its objective, that is because even an institution guy who is not tracking a particular issuer, he will not know what that issuance contains, whether it is secured, whether it is unsecured, whether it has any guarantee, whether it comes with any any collateral or anything. So that is when a broker comes into the picture. They have a call, they discuss, and they say, okay, these are the terms and conditions of the bond.
Right.
These are the terms and conditions of the bond, and that is why I price it like this.
They solve the customer problem for them.
Exactly,
Yeah.
exactly.
Tom, some points Vijay made, and you referred also to the earlier panel. And it just struck me that one of the things we missed discussing was CDS. So there was a lot of effort done to, get a CDS market going in India. I was part of several of those. There was a committee, then there was a follow-up committee, Bindra committee was there, and so on. It started, a few people did some trades, and nothing happened after that. But a CDS, active trading CDS market, would have solved a lot of the points that Vijay just made and were made in the earlier panel. In fact, Mr. Venkat made the point about speculators, people to trade. And it is much easier for people to trade a derivative because there's comfort of not needing too much liquidity.
Equity-like.
Absolutely.
Yeah, and also harmonization, which is the point he just made. Unfortunately, and there is a very, very easy reason why it didn't take off. Okay, the reason is that the largest holders of credit risk are guys who are not going to trade. They want to hold it to maturity. It's all the public sector banks primarily, and some private sector banks as well. The guys who would like to trade don't have any credit risk on their book of any size. So the conflicting interests just don't emerge in the market. So there is no appetite on either side, or if there is appetite on one side, there is nothing available to fill it.
So my observation is that when I think of the largest customers in the global market, among the largest customers in the global market are insurance companies. They need assets, they need longevity, they need duration. They happen to be, despite the nomenclature here, they happen to be among the more active traders. Now, not every day, certainly the new issue buyers, they're among the largest. They elbow BlackRock out of every deal if they can. But the net is they trade strategically, and they can do that in the global markets because of that two-way capability, that two-way dealer flow. I think you're right. But again, my observation, seeing what I like to say is I've seen this movie. I know how it ends. How we get there and what comes first versus what doesn't is I'm not sure. But we'll, we don't have to get there tomorrow, right? Where we are. But there are going to be a number, in my mind, there are going to be a number of evolutions. And I would say this to the dealers in the room. I think there are some dealers, and when I say dealers, I mean traders, that could make two-way markets. If I was a government trader in India, government GSEC trader in India, and I woke up one morning and I got an email from the RBI that said, starting Monday, you're trading electronically on NDS OHM, I would have been quite disappointed with that evolution, right? Because that just said my ability to dictate my outcome on a given day or in a given moment was just now changed because everybody has this same thing that I have, and I have no advantage except if I'm a good risk taker, except if I've got a big balance sheet. I think that in the corporate market, you don't want that to happen.
Yeah.
You want to let the market organically, as members of the community, come together and figure out how this can work. I mean, will there be a day when one can short corporate bonds in India? I'm not sure the history as to why not, but I would think in the natural evolution of liquidity, that will likely occur. And secondly, I also think that there'll be people who will want to be market makers, and there'll be insurance companies that want to trade because they see value opportunities, and they'll be confident of the liquidity. And I think, again, this is the first innovation panel, right? You mentioned this one.
Yeah.
The fifth one, my guess is we'll make a lot of that progress, right? We'll have seen the evolution, and we'll also have, combined with that, just the natural growth in the marketplace, right? The market's going to double at a minimum over the next 5 years and then double again. And I would expect that will really complement all the advances that we would expect to have. And I would think the market community, I think one of the goals that Harmoney has is to just make it easier to do that, do whatever it is you're trying to do. Not not to change the transparency in the market, but to work with the market so that the processes are available. The technology's there. Do you need it today? You need some of it today, and you need to have it in place in order to make that advancement. Let me just say this, and Manoj, I got, the word motivation came up a lot in the first panel, right? Just contrast it. In the US, one of the first motivations for electronic trading, I will say this from a dealer side, was not transparency. That's the last thing anybody wanted.
Correct.
But there was a need for trading efficiency. In 2005, we were trading 10 billion a day as a market. Today, we trade 50 billion a day as a market, just to contrast the growth in the US market. But the net was the mistakes that were being made, transposition mistakes, errors, when you weren't dealing with a system and you had a pen doing everything for you, the errors and also the ability to deal with clients when you had 50 clients coming in and trying to do something on the back end of a trading system, there was a need for efficiency, and that was a major driver. Price discovery was somewhat of a driver, not from the dealer side, but from the client side. So operational efficiency and trading efficiency were really there. The other thing that layered in there, and maybe it plays in here a little bit, compliance and regulatory. In those days, compliance was, they were in the back office in another building, and nobody knew who they were. Well, now they're like right down the row on your trading desk, and they have more power than you do on a given day. If they say, I'm not sure about this, you're like, oh, please be sure. So I think that's an observation I make. Let's get back to motivation. What do you see as perhaps the motivations, maybe starting with you, Manoj, just where can we come to get people motivated to help the process along, as opposed to waiting for the regulators to help it along for us?
So the pessimistic view, unfortunately, is that seeing this market for, I think, 30 plus decades that I have, unfortunately, it's a regulatory push that will do it. That's a pessimistic view. That's worked for government bonds and might just work for corporate bonds as well. Having said that, the more optimistic view is maybe we should do the small things, first, i.e. make it simpler to trade. Instead of 5 screens, 1 screen, and that automatically leads to people find it easier to do things, and that moves stuff naturally towards lesser manual intervention, more electronic activity.
Absolutely.
So and I think NSE, BSE have both played their part tremendously well.
Correct.
For other asset classes. So I don't see why that same thing cannot happen. Maybe NSE and BSE are not best placed to do it, but why not? I mean, Harmoney is trying to do it in its own small way. But certainly, I think there is scope for, if market participants support, and organizations like AMFI, and I think Vijay put it very well that it's really the members of AMFI who are the guys who provide liquidity today to the market, right? It's not really the banks who are giving liquidity on corporate bond side. So willy-nilly, whether it's because they have no choice, they have outflows, so they have to sell, and when they have inflows, they have to buy. It's not really trading for the sake of trading. But having said that, maybe that's the way forward. But it's important to co-opt organizations like AMFI, market participants who are very active, maybe the top 10 active mutual funds, the top 10 active banks, the top 5 or 10 active primary dealers, and get them to do the small steps first, and then you move to the bigger ones.
So if I can just complement what Manoj mentioned, I think if you take a step back, when you come to the topic of motivation, I think you also look at the ingredients that are available today, right? We're looking at the lack of an end product here, where the end product is a deep, wide, liquid sort of corporate bond market. But let's look at what's in there. What's in there, interestingly, this year, for example, is $40 billion of primary corporate bond issuance. Now that's a massive size, right? Even for a GDP of the size of India, a $40 billion primary market exists, right? And it's real. So the motivation from an issuer perspective is out there. It's evidenced. I think the other aspects, and I know there's been a lot of talk of lack of motivation of traders, etc., and a lot of regulated sort of investing. But the world is changing. What's changed most interestingly over the last 3 or 4 years, and this is where platforms like OTPP platforms like Harmoney will come in, is look at the motivation of the new money investors. Forget the old money investors. The asset managers will do what they will do. The insurers will do what they will do. And that's what probably changed the world in the United States. But what's changing here is today you have the world of the unregulated investor. Pools of money are now moving and moving very quickly from the asset management industry into private hands. So you have wealth, which is a huge investor. You have the body corporate, which is taking back its money from the asset manager, getting wiser in fixed income and saying, I can do this myself. I don't really need an asset manager. If it's a wider choice, a deeper market, why can I not pick up 2 bankers, 4 traders, and get going? And believe you me, the corpus in wealth and in corporate investing is something that is being massively underplayed in our ecosystem. I know we pay a lot of attention to SEBI, we pay a lot of attention to what's happening in AMFI. We do not pay a lot of attention in what's happening in the wealth space. That space can revolutionize investing. So that's your motivation coming back. Family offices, absolutely. So wherever you have regulated credit dimensions, the family office, the corporate, the wealth sort of corpus completely demolishes that myth. And that completely deepens, widens the corporate bond market. So on one side, you have the motivation of the issuer, and that's demonstrated, evidenced through $40 billion. On the other side, you have this completely changing quality of money or quality of pools of money. And that will revolutionize investing. So you know what? Whether SEBI comes in or not, whether the RBI comes in or not, whether we can actually get regulators to play a role or not, I am going to look at the 2 perspectives that Manoj put forward very carefully, which is the pessimistic and the optimistic approach. I don't think there is a pessimistic approach here. Motivations are so deep and so wide, this will change. The speed of which, where regulators will come in, where Harmoney will come in, is they're going to be catalysts. The reaction is there. It's going to happen. It just depends on how hastened or how quick that reaction's results will show. That's one aspect of it. I'll just quickly put the other aspect out. Look at what's happening in India to the other credit channels. Who distributed credit in India before the corporate bond market? It was the banking system. The banking system has tripped over itself several times. And what we have today is a far, far more conservative banking system than we're used to. Amit said, and we've quoted Amit various times, he said this comparison between loan pricing and bond pricing. But lo and behold, loans are no longer the first port of call, right? The banking system is not available to a lot of the segment that needs capital. And the moment you have that situation, again, arbitrage-free pricing of money will bring that to the capital market. So I think the capital market has just got too much motivation not to grow. It's the pace of growth that will be defined by the role of the catalysts.
Thank you. I just, maybe you made me think of, back to the efficiency topic of the evolution. The fact of the matter is, in market access's first iteration, the whole message was, and I was at Morgan Stanley running the trading desk at the time, all we want to do is copy what you're doing now and just make it easier for you. You're trying to chase around all these prices. If you do it on the screen, it reports into your system, it's easy. And I think, this is what Harmoney has said, okay, what is it that works for you, and how can we make it easier? And maybe others are trying to do that too, but I know that that's the focus of the Harmoney team. Vijay, I would be remiss if we didn't spend a few minutes on Gift City. And Ajay, I would be remiss if we didn't talk a little bit about the FBIs. So sure. In sequence, let me start with you, Vijay. How does Gift City, and a very, again, from my outside perspective, a very exciting development, kind of dictated by the Prime Minister and the government, but we're going to want to get in the cutting edge of the evolution of capital markets here in India, and this is a way that we can motivate and extend that. give us your perspective on how that might play within the fixed income markets, the corporate market, the fixed income markets in general, please.
Surely. Gift has had it's in a very, it's a very interesting crossroad that we are in with Gift. So, an evolution, it's the idea and everything began in 2014. The ecosystem started developing. So, India INX was the first exchange to set up there somewhere. So, today apparently happens to be our 8th foundation day.
Congratulations.
Thank you so much. So it's our 8th foundation day. So we were the first exchange, to be established there, and it's been a little more than 6 months that I've been there. And when I went there, I had my own perspective and own thought about what it is and what it is not, except that read into some articles and newspaper stuff. But very surprisingly, when I went there, that ecosystem is now, so post-COVID, so I would say in the last 2 years, there's been a lot of activity which is happening. So activity which is happening on the fund space, right, on the fund space. So today we have about 130, 140 funds who have set up with about 200 funds already into existence, all right, and people are moving their funds that's established in a Mauritius, to Gift. So that's one area which is really developing and really developing very fast from a capital market perspective. The other thing is there's an ecosystem that's well developed. There are 2 exchanges now. There is a depository which is already there. There's a credit rating agency which is already in place. So all these things are now as an impediment or the essential launchpad for growth is already existing there, right? Essentially, Gift or IFSC as a region has been predominantly now a debt space, right? Because equity, it's only been derivative transaction which is happening there, because there is no listed there right now, given that the regulations have just come out towards the end of August. So what is there is, we have about 140 bonds which are already listed at IFSC, and 141 of them are at INX, right, at India INX, and we have a 100% market share there. The other interesting thing which is happening there and that's developing from a corporate bond perspective is that's slowly becoming a hub for sustainable and sustainably linked green bond kind of a space. So we already have about 18 issuers who are there and raised about more than 14 billion of worth bonds which are green, sustainable and sustainability linked. Now, what is it that is driving them there? So anybody who needs a foreign currency bond or anything that needs to be raised in foreign currency, like an incentive or a motivation that we really spoke about. So right now the motivation has been cost and the tax aspect of it, right? Because for somebody as an issuer who's coming there to raise bonds, okay, the withholding tax is only 9%, all right? In the Indian domestic market, it is 20%. In a Singapore, it is 15%. So very clearly, I am having a clear between 6 to 11% I'm saving, right? If I want to go and list, and people may talk about trading, but I have seen statistics. The bonds that are getting, the bonds that are getting listed in a Singapore or London or at Lux SE do not trade as well there, right? So there is no trading there, right? So people might say that, okay, they are just coming for a thing and there may be trading there, but absolutely, insignificant number of trades that has happened on any of these bonds, right? So for them right now, the motivation or the incentive for them is really very clearly the cost on the tax aspect. So now is the time, because now the listing has happened, we have X amount of issuers. So we have 53 issuers in all who have listed there, and about 45% of them are repeat issuers who keep coming back, time and again. So this is some of the very clear incentive which is there, and the regulations there, the regulator themselves there are quite progressive. They are very proactive, right? So what they have done is, instead of copy pasting the regulation which is there on the domestic side to IFSC, which could be the most easiest thing that could have been done, but what they have done is they have actually made a very prescriptive regulation, and because most of the people who are there as regulators have already worked here under SEBI. So they do know what are the challenges that people are facing on the domestic side of the market. So there's a lot of ease which has gone there for somebody to come with a pre and a post compliance aspect, right? So that makes it easier, cost effective from a compliance perspective for somebody to come and issue bonds and raise capital, right? From a secondary market perspective, of course, we are some time away for that to really move on and do things. But the best part is there is a lot of issuance which is happening. We are in all since inception, I think so. It's been more than 64 billion USD that's got raised in debt there, right? So that's a significant number. And just to throw some perspective, in the first half of this financial year, right, we've had more than 35 issuances that has happened at IFSC, at INX itself. 35 issuance, which is way more than that has happened in any financial year put together. Right?
Staggering number.
Yeah, so that's a big number which is happening. And even today, I've been in Bombay and I've been doing a lot of meetings. Even today, people are really talking about how do we, what needs to be done so that, we get there to do more. And slowly but steadily, even the regulator there has slowly started now saying that, okay, now a rating is compulsory. You have a rating agency. So what they are now started thinking as any regulator is investor protection.
Sure.
Right? So it's like, okay, now I have given you this space. Now let me slowly get into some of these aspects. So what has happened is with repeat issuers, there's a lot of confidence that, okay, this is an easy process. I can get things done very easily. There's a lot of, we spoke about operational efficiency, right? Yes. So there's a lot of operational efficiency that I'm getting out of it, right? So I don't mind going there again. Although there are a few things that I need to now take care of in terms of ensuring that there is investor protection and other things which is happening, but it's much more easier for me to do that. So that's what is actually being happening there, and that's the way that I see that it's being taken forward. The best part is the regulator is very open.
Supportive.
It is very supportive. Is very open with the entire thought process.
I think it's become a key complement to the evolution of the financial markets, right?
True.
It just wouldn't drop down from a helicopter.
It's a unified regulator as well.
It's a unified regulator as well.
Unlike here where we have conflicting.
Well, just a last question, just to, the international perspective, the marketplace has provided a motivation to all those foreign investors to get more exposed to India with the inclusion in the indexes. So we've seen a lot of flows so far. What's your perspective on that, Ajay?
So I think, again, from a motivation perspective, like you correctly said, the international investor, given the rate environment last year, given all of the index inclusion sort of coming in last year, was fairly motivated to come in. And we've seen a fair amount of flow in govies. I think the picture, though, and is not complete. What we really need is participation from the international investor in our credit markets. Because what you want is another channel through which India can raise capital. The government, quite frankly, if you ask me personally, given their fiscal discipline, given their fiscal path, may not necessarily need this international capital. Who needs the international capital is Growth India, and Growth India is corporate India. That, to be honest, has things to be done yet. And some of the processes which we believe are developmental from a market perspective, take the RFQ platform, for example, are not exactly perceived by the FPI community that positively. Because for them, it's another hoop to jump over. And please understand, my own personal view, and having traded India from India and now trading India from outside India, is that we don't necessarily treat FPIs with the sense of, let's say, equality or equanimity that we need to, right? They're always, when we need them, we kind of ease regulations, they come in, and then suddenly then somebody makes a comment saying, once they're 10%, we might actually cap their, and imagine yourself to be a portfolio manager sitting in Singapore, just putting $1 billion and feeling, oh my God, these guys are going to cap this and I'm going to have to take the money out, and I don't know whether I'll have a job if the money gets stuck in there. So some of these regulations need to be consistent. I think a commitment to consistency is probably the first mantra that needs to come out from the government, from the ministry, towards FPIs. I think the process for FPIs to come and trade needs to be made as simple as possible, right? And
it's clear it's not right now.
It's not right now. And so probably best
I'd
to
also
get a...
say that complements the point we're making about the Indian market as
Oh,
a
yeah,
whole, right?
absolutely.
The corporate, it's not that easy for
No.
someone here too. I mean, it works. For the size of this market today, it works.
It works.
Where we're going, I say we, meaning
Correct.
India is a fixed income market.
Correct.
It
Also,
needs efficiency.
I don't remember, and Manoj, correct me if I'm wrong, if there was ever a committee or a group of people who were put together, which said, how can we ease debt market access for FPIs?
So there have been committees, to look at FPIs as a, participant. And the latest one, there was a SEBI committee with Malingam as chairman. But invariably, I do remember even it's very blow hot, blow cold, unfortunately.
Correct.
Like for instance, when the FCNR
US
issuance was
downgrade
happening,
happened,
then you are looking at who's going to subscribe, etc. So it's always related to now there's a crisis. Let's see how you can.
Opportunism.
It's opportunistic. True.
And
it's not been very
regulators who would not be one to remembered for their opportunism.
And
right?
then the consistency doesn't stay in your approach.
Yes.
Well, I will pause there. I want to thank everyone on the panel. Manoj, double duty today. And just open it up for if there are any follow-up questions. And I know we're all going to be, hopefully you're all staying for dinner and cocktails and conversation, or tea or whatever you'd like. But the net is, let me open up if there's any questions for the panelists before we hand it over back to our host, Sharman. Any questions? Yes, please. Here comes your microphone.
Yeah, hi. So my question is to Ajay and Tom. So you have been the global CEO of fixed income of Nuvama. So what difference do you see in the international market and Indian market, and how Indian market can improve, or other markets doing well, we can improve that, or Indian fixed income market doing well, or we can implement that strategy or something? So what difference or what do you see?
You want to take that, Tom?
Well, I was a little stunned with the lack of ability to short. And I don't have, to be fair, in my 3 trips here to Mumbai, I've not really understood the motivation, but I'm sure there was some reasonable rationale for that, to protect the market or what have you, and to protect investors. But at some point, the market will grow to a point where that will free up. Citadel wakes up every day, and you all know, I think you know who Citadel is, and Ken Griffin. They wake up every day trying to find a new market to make a market in, right?
Yes.
They don't know how to not make markets. And if you were to tell them, well, you can come and make a corporate bond market, but you can't be two-sided unless you own the bond. They would be, why, what? That's not a market. I mean, I want to short anything that somebody wants to buy, and I want to buy anything that anybody wants to sell. And it's just a question on my part to figure out valuation. So that's, I think, a key evolutionary ingredient that will occur, I suspect, with consultation with the regulators. 1. 2, efficiency. I mean, it said 15 to 30 minutes for a trade. If it took me 15 to 30 minutes for a trade, I think I would find a new career. I'd drive myself nuts. Even if it paid well, I think I would go crazy. So the net is, you need to introduce, there's technology, and maybe there has not needed to be forced, but also nobody's presented it in a way that might make it sense. And who knows if Harmoney has the answer or not, or somebody else does. But technological evolution is going to definitely impact the willingness to embrace the advancement in the market, in my mind.
I think I'll just compliment what Tom said. I think it's very important to understand any fixed income market contextually to that country. So when you read about Japan and the growth of the Japanese fixed income market, do not attempt to put India under the same lens. It will not work, right? Very different growth dynamic, very different demographic requirements. Exactly the same with Europe, exactly the same with the United Kingdom or the United States. So I think it's important to contextualize. I think one amazing thing, a lot of people were talking to me the other day and said, so I get a lot of conversation about retailing in corporate bond market. It seems to be the hottest topic. I'm surprised every day's Economic Times headline is not about retailing corporate bonds. The incredible bit is India does not even have investor classification sorted today. So a retail investor is treated pretty much, if you have the money, you're pretty much treated as an asset manager. And the qualification for the two are apples and oranges. The retail investor with $5 million, which he's made selling, 14 acres of land in Sector 24 in Haryana, is going to be treated as Nippon Asset Management. You have a serious problem there. So I think there are certain aspects of our corporate bond market, of our bond markets in general, fixed income markets, which need serious amount of refinement. But look, patience is the key. It'll come, right? These are new things, right? The price of land in this country has shot up in the last 10 years, right? The monetization of that land is happening today. Some of that monetization will come into fixed income. So these things will happen. I think it's important people talk about it. What I get disappointed most times is that some of the fixed income conversations in this country have started to dim down. And therefore, hats off to somebody like Harmoney for actually getting them activated again. And they have a very good platform which will enhance liquidity, but also just enlighten people about how fixed income investing needs to be conducted. As simple as that. And encourage the regulator, rather than be afraid of the regulator. If you go to SEBI and say, we'd like to work with you to classify an investor, somebody who's got $100,000 to invest and somebody who's got a $10 million to invest should be treated differently, should need to go through certain certifications and then be permitted to invest. So investor protection will come automatically. You don't need somebody to supervise investor protection, because they will take care of themselves if you have certification. So I think you've raised a very good question. There is a huge journey that needs to be had. It's beginning in bits and pieces, but we need catalysts to drive it.
Yeah, thank you.
Thank you.
Thank you.
Back to our host for the day. I think we are less than 4 minutes away from cocktails. Am I right?
Give or take.
I just want to let people know, to be at ease, it's 4 minutes away.
So, thank you, Tom, for that. And thank you to the panel and the speakers. I'd like to invite Aditya on stage one more time to present a small token of our gratitude to all of the speakers.